Imagine buying Apple stock at 2 a.m. on a Sunday, selling Tesla stock during halftime of the Super Bowl, and scooping up $20 of S&P 500 at 10 p.m. on a Monday, all from your phone. This has never been possible until now, thanks to tokenized stocks.
All right, for our main story, Robinhood shares popped more than 9% as of midday after the retail trading platform announced this morning that it's pushing deeper into crypto by launching tokenized stock trading for European users. The move would allow customers in the region to get exposure to the U.S. stock market.
In the next few minutes, you'll learn exactly what tokenized stocks are, how they work, the real platforms that are live today, the big benefits, the risks, and a simple 5-step roadmap to explore them safely. Stick around to the end for a peek at where tokenization is going next. A tokenized stock is a digital token on a public blockchain that legally represents a share of a real company. Think of the token as one of those tickets you get when you check in your coat at a fancy restaurant. The coat, the actual share of Apple stock in this example, sits in a secure closet called a custodian. The ticket, your token, lets you hand that claim to anyone, anywhere, without ever opening the closet door. You can swap that token with a friend in Tokyo, and a legal claim to that Apple share jumps wallets in seconds, even though that share itself never leaves the closet or the custodian. So who prints these claim tickets? A licensed firm sets up a special purpose vehicle, or SPV. Picture a steel lockbox with glass walls so that auditors can peek inside. The SPV buys real shares on the stock exchange through an ordinary broker, places them in a segregated account, and then mints exactly one blockchain token for each share. Tokens flow to exchanges like Kraken, Bybit, or Robinhood. When you hit buy, the exchange matches you with a seller, updates the ledger, and the token lands in your wallet. When you sell that stock later, the SPV burns your token and unloads a matching share for that stock. Quarterly validation proves the number of tokens can never exceed the number of shares that are in custody. Let's make it real with Sarah's story. Sarah's a software engineer in Manila. Late Saturday night, she reads that Tesla's new battery factory just set a production record. U.S. markets are still closed, but Sarah opens her Kraken app, trades $25 of stablecoin USDC for 0.083 units of Tesla X token, and parks them in her hardware wallet. When Wall Street opens on Monday, Tesla stock gaps up 4%. Sarah swaps her tokens back to USDC, the stablecoin, moves the funds to a local exchange, and cashes out to pesos. No Monday morning wait, no international broker, and no minimum account balance needed. Platforms like Kraken's X stocks make this possible. In March of 2025, Kraken launched more than 60 tokenized tickers, including Apple X, Tesla X, even S&P 500 ETF token, through a partnership with a Swiss firm called Backed Finance. You can even withdraw the tokens to self-custody. Now, I do cover self-custody and hardware wallets in another video. I'll try to link that above or down in the description below. Over in Europe, Robinhood's Lithuania pilot lists 200 stock tokens, including private giants like SpaceX, OpenAI, which is the makers of ChatGPT, for customers in 16 countries. In Asia, Hong Kong brokers have issued tokenized bonds under brand new rules and are lobbying to add stock tokens next. So why are people buzzing about tokenized stocks? Well, there are a lot of benefits. The first one is 24/7 trading. Traditional exchanges run about 32 hours a week and shut down for holidays. Token markets run for 168 hours, letting investors react to news instantly. Another benefit is fractional ownership. Amazon trades near $3,000 a share, but tokenization lets you buy $10 worth, sliced 8 decimal places deep. The third benefit is global reach. A student in Nigeria, a farmer in Brazil, a retiree in Poland can all hold blue chip US equity exposure with nothing more than an internet connection and a crypto wallet. The fourth benefit is lightning fast settlement. Conventional stock trades take 2 business days to finalize. Token transfers finish in mere seconds, so capital can be reused right away. The fifth benefit is composability. Because tokens live on a smart contract network, you can drop them into decentralized lending pools, use them as collateral for a stablecoin loan, or automate trading strategies through open source code. Now, I know this sounds like a lot of fancy talk, But this is coming, and this is real. Some countries already allow this. Other countries, like the United States, is, as we speak, regulating or creating regulations so that we can utilize these technologies to the most benefit for us as investors. Your Apple stock token becomes a Lego brick in a bigger digital playground, something a traditional brokerage account simply can't do. There are a lot of great benefits, but let's take the flip side and look at some of the risks. The first risk is thin liquidity. Tokenized stock markets are tiny. A $50,000 order could shove the price up or down a lot, especially on weekends when market makers can't hedge on Wall Street. The second risk is peg drift. Tokens should mirror the real share price, yet from Friday close to Monday open, a token can trade at a premium or a discount. You might score a bargain, or you might overpay and get slammed when the gap shuts closed on Monday morning. The third risk is regulatory uncertainty. Binance launched stock tokens all the way back in 2021 and shut them down months later just because of regulators objected and we needed a little bit more clarity, which I think we're getting this year in 2025. Today's players are more careful, but rules still can vary by country and can change fast. The fourth risk is custody failure. You rely on the issuer to keep real shares in escrow. If they go bust, your tokens could become IOUs. And then there's the fifth risk, limited shareholder rights. Tokens give you economic exposure, but usually no voting power, no proxy mail-in, and no seat at the annual meeting. Risk number 6 is tech hazards. Smart contract bugs, exchange hacks, or lost wallet keys can erase your investment instantly, and there's no password reset hotline for the blockchain. So where do regulators currently stand? Well, Europe leads with a sandbox called DLT pilot regime, plus the broader MiCA framework. If a token mirrors a security, it must meet familiar disclosure and custody rules, but at least the pathway is clear, which is why Robinhood chose Lithuania. Hong Kong already allows tokenized bonds and signals that stock tokens will follow once local exchange monopoly laws modernize. The United States is cautious. The SEC once forced Binance's shutdown and has yet to greenlight a retail stock token offering, so most platforms simply block US clients for now, but I do have confidence that that will change probably this year in 2025 with the new administration and the new SEC head. Are you thinking about dipping your toe into stock tokenization? Well, follow this 5-step safety roadmap. Step number 1 is confirm tokenized stocks are legal where you live. Some exchanges do geo-block entire regions. Step number 2 is use a reputable venue that publishes regular proof of reserve audits. Step number 3, read the prospectus, verify that one-to-one backing, redemption procedures, and how dividends, splits, or mergers flow through to token holders. And step 4 is start small, enough to learn, not enough to jeopardize your entire nest egg. And then track liquidity and place limit orders to control slippage. Step 5, lock down security. Use strong passwords, two-factor authentication, withdrawal address whitelists, and if you're self-custodying, use a hardware wallet to keep it offline. If we zoom out, you'll see that this tokenization is racing ahead. Governments have issued multi-billion-dollar bonds on public blockchains. A German state bank floated a £100 million bond on Polygon just this year. And platforms like Realty let investors buy fractions of Detroit rental homes and collect daily rent in stablecoins. Even gold bars, fine art, music royalties are all moving on-chain. Boston Consulting Group projects real-world asset tokens could top $16 trillion by 2030. Tokenized stocks are simply the opening act in a much larger transformation. In summary, tokenized stocks blend Wall Street's blue-chip assets with the internet's always-on convenience. They deliver 24/7 access, bite-sized minimums, borderless ownership, instant settlement, and smart contract superpowers. Yet they bring thinner liquidity, potential price gaps, legal uncertainties, custodian dependencies, and brand new security chores. Treat them as high-tech sandbox, educate yourself thoroughly, and never invest money you can't afford to lose. If the trend matures, which I'm confident it will, finance could shift from closed ledgers to open networks, putting every asset you know on rails that run at the speed of the internet. If this breakdown was helpful, please hit that like button or subscribe and share it with a friend who still thinks blockchain is a scam. drop a comment down below and let me know if you would try buying a tokenized stock. And let me know how it goes. What platform are you planning to use? Are you planning to go with Robinhood or Kraken? Or are you in a market that just doesn't allow it and you're looking forward to the time that you can buy tokenized stocks? You don't want to miss my next video where I show you how tokenization could let you co-own a racehorse or a vintage Mustang or even a piece of Mars mission hardware. We'll see you next time. Thanks again for watching. Have a great day.